Was feeling a little tired after a morning of activities. Medical appointment followed by grocery shopping. Lost some blood and still had to carry heavy bags. After settling down at home, I read the news and I suddenly felt energized. DBS increased their dividends to 48 cents a share per quarter. Huat. The decision to invest in DBS back in 2016 at $13 to $14 a share and continuing to accumulate over the years whenever Mr. Market felt depressed is paying off handsomely. Annualizing 48 cents a share, annual dividend per share is $1.92, which means the dividend yield on my initial investment is in excess of 14% per annum. Of course, with DBS being one of my largest investments, this is probably going to have an outsized impact on my passive income for the year. I so stunned like vegetable. What is even more impressive is that the higher dividend is probably sustainable. DBS revealed that the expected catch-up in funding cost has not been as bad as feared. In fact, net interest margin saw a further increase of 12 basis points, quarter-on-quarter. Net profit grew 48% year-on-year and 5% quarter-on-quarter. I have said before that DBS is able to trade at a juicy premium to book value because of its very impressive return on equity or ROE when compared to UOB and OCBC. DBS saw its ROE hit a new quarterly high of 19.2%, up from 13.4% in the same quarter last year. With banks, we often see price-to-book value and PE ratio being used in determining fair value. These are good ratios to use but, of course, they do not tell the full story. They do not explain why DBS trades at a rich premium to book value while OCBC does not. This is because of return on equity or ROE. DBS has always demonstrated its ability to deliver a higher ROE than its smaller peers. Return on equity is a measure of how well a business uses equity or the money contributed by its shareholders plus its retained profits to produce income. DBS has certainly demonstrated its ability and willingness to increase dividends in the past. It could certainly increase dividends again in the future if it is able to maintain a relatively high return on equity. On top of this, DBS has a CET1 ratio of 14.1%, which is in excess of what it feels is optimum. So, we could possibly see higher dividends to come if DBS has no better use for the money. DBS could, of course, simply hold on to the money for a rainy day. Whatever the case might be, DBS is a rock-solid investment for both income and growth. Yes, just like what I said about investing in UOB, we can have our cake and eat it too. OCBC should deliver good results tomorrow too. I am feeling so giddy now, I need to go lie down for a bit. If AK can do it, so can you.